Welcome to The Explainer. Today we're breaking down a huge signal that's flashing in the U.S. housing market. And if you have capital in California, or you're looking to put some to work, you need to understand why the Golden State is playing by a completely different set of rules.
So let's start right here with this number, because honestly, it is the key to understanding the entire national picture right now. 43.1%. So what exactly is it telling us?
Well, that number represents the surplus of home sellers over buyers across the entire United States. To put it simply, for every 100 people out there looking to buy a house, there are more than 143 people trying to sell one. That is a massive imbalance, and it's a clear signal that the market is shifting. And for us as investors, that demands our attention.
Okay, so let's dive a little deeper into this national trend and what's really driving it. Because, this context is absolutely essential if we're going to understand California's unique position in all this.
Just look at this chart. The seller surplus has absolutely jumped in just 1 year, going from 28% all the way up to over 43%. That kind of move puts the national market right near a recent record imbalance. It is a huge shift in a very, very short period of time.
So the big takeaway here is that this is not random. We're talking about nearly 600,000 more sellers than buyers nationwide. And why is that? Well, it's a mix of high housing costs and this kind of persistent economic uncertainty that's really just squeezing demand. The direct result? Buyers across the country now have more leverage than they've had in years.
But, and this is a big but, here's where it gets really interesting for us. While the rest of the country is shifting, California is bucking that trend. It is telling a very, very different story.
So unlike Sunbelt states, think Florida and Texas, where housing inventory is just surging, California's major coastal hubs are proving to be far more resilient. The market here is holding steady, and it's showing conditions that are way more balanced.
All right, so to really get a handle on these differences and make smart investment decisions, we need to get into the key metric that analysts are using to really gauge the health of these markets.
And this is it. This simple but really powerful metric, the seller surplus. Think of it as our guide. It's a direct measure of the balance of power in any market. If you see a positive number, that means sellers outnumber buyers, which tilts the advantage and, of course, the negotiating power straight to the buyer.
Now, what's really cool here is how this framework classifies the market climate. Anything over a 10% surplus, boom, that's a buyer's market. A negative surplus means it's a seller's market. And that sweet spot right in the middle? That's what we call balanced. Keep these numbers in your back pocket as we go forward.
Okay, so we're armed with our new metric. Let's move on and see how this actually plays out on the ground across specific California metro areas. This is the tactical view every investor needs.
And this just brilliantly illustrates the California difference. I mean, look at this comparison. The U.S. average is a whopping 43.1% surplus. That is deep, deep in buyer's territory. San Francisco, on the other hand, is sitting at just 12.1%. Now, yeah, that's technically a buyer's market by our definition, but it is worlds apart from the national average when you talk about balance.
Think of this table as your scouting report for the entire state. It ranks California's major markets from top to bottom. You can see the whole spectrum here, from the most balanced markets like San Francisco and San Jose right at the top, all the way down to the markets with the most buyer leverage, like Los Angeles and Riverside at the bottom. And notice Anaheim. It's right in line with that national average, while LA and Riverside, well, they offer even more of an advantage to buyers.
So all of this just begs the question, why? Why is California holding so much steadier than all those other, formerly hot markets in the Sun Belt?
And the answer really boils down to a real estate fundamental, supply. You see, in the Sun Belt, there was this massive ramp-up in home building that created a huge surge of inventory. California, on the other hand, just didn't see that same level of new construction, and that's what's kept its markets from becoming totally oversaturated.
And let's put some hard numbers to that, because this is wild. Look at the surplus in Miami, 148%. Austin is at 112%. Now compare that to Riverside, which is California's market with the highest surplus on our list. At 66.4%, it's still less than half of what's going on in Miami. It's not even the same scale of inventory glut.
So let's bring it all home. What should you, as an investor, take away from all this? What's the actionable intelligence here?
Well, the current landscape really presents a clear strategic choice. Are you looking for the relative stability and the resilience that you find in California's more balanced markets? Or are you more of a bargain hunter, looking to deploy capital in those regions with soaring inventory where you might have a lot more negotiating power?
And that brings us right to our final question, and it's one that only you can answer for your own investment thesis. Based on this data, where do you see the opportunity for your portfolio? Is it in the stability of a market like San Francisco, or is it in the potential leverage of a market like Riverside? Thanks for watching.